Hey there, savvy investors and curious minds. Welcome back to the channel where we decode the complexities of the stock market. Today, we're diving deep into a fascinating corner of the market, hard to borrow stocks and the mechanics of a short squeeze. We'll be putting a spotlight on a specific company that recently caught our attention, CCTG International Holdings Limited, trading under the ticker CCTG. Get ready to understand why some stocks become incredibly expensive to short and what that could potentially mean. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on CCTG International Holdings Limited, or CCTG. This company operates in the industrial sector, specifically within electrical equipment and parts. With a modest market cap of just $3.05 million, CCTG designs, manufactures, and sells interconnect products internationally. Show CCTG chart last 30 days. Looking at recent price action, CCTG has been quite volatile. While it's up a significant plus 65.61% over the last 30 days, it has pulled back minus 10.90% over the last 5 days, and today, it's seen a slight positive bump of plus 1.25%. Volume-wise, today saw 136,000 shares trade hands, which is a stark contrast to its 30-day average volume of over 11 million shares. This translates to a relative volume of 0x average today, indicating unusually low trading activity compared to its recent past. What is cost to borrow and why it matters? Before we get further into CCTG, let's break down a critical concept, cost to borrow, or CTB. When an investor wants to short a stock, they first have to borrow shares from someone who owns them. This isn't free. The lender charges a fee, expressed as an annualized percentage. This cost to borrow is essentially the interest rate you pay to hold a short position. When a stock becomes hard to borrow, it means there are very few shares available to loan out. Just like any scarce commodity, when demand to borrow is high and supply is low, the price, or in this case the CTB fee, can skyrocket, often well over 100%, sometimes even over 1000% annualized. These astronomical fees significantly increase the cost and risk for short sellers. Why the stock is hard to borrow right now. Now let's apply this to CCTG International Holdings Limited. CCTG has appeared on our hard to borrow screener for some compelling reasons. Its current annualized cost to borrow fee is an astounding 635.7%. Highlight 635.7% on screen, while the CTB momentum has seen a slight dip of minus 18 percentage points over the last 5 trading days, meaning it's become a tiny bit cheaper to borrow than it was last week. 635.7% is still an incredibly high number by any measure. Furthermore, the shares currently available to borrow are extremely limited, with only 10,000 shares reported. When you consider CCTG's estimated float is 3.0 million shares, having only 10,000 shares available for shorting is incredibly tight. Our internal composite squeeze score, which factors in CTB, borrow supply, float size, and price momentum, currently sits at 40.1 for CCTG. This score isn't signaling an immediate imminent squeeze, but it does indicate that several underlying factors are present that could contribute to a short squeeze scenario. Squeeze mechanics explained. So, what does it mean when a stock like CCTG has such high borrow fees and low share availability? It sets the stage for a potential short squeeze. A short squeeze happens when a stock's price starts to rise, putting pressure on short sellers. These short sellers, who borrowed shares hoping the price would fall, now face mounting losses and ever-increasing costs to borrow fees like that 635.7% we see with CCTG. To limit their losses, or due to margin calls from their brokers, they are forced to buy back the shares they sold short. This covering action creates buying pressure, which pushes the price even higher. This upward movement can then trigger more short sellers to cover, creating a cascading effect, or a squeeze. The dwindling supply of borrowable shares, like the mere 10,000 for CCTG, can further exacerbate this by making it harder for new shorts to enter or existing shorts to roll over their positions. It's important to remember, however, that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to stay short. Dilution risk check. One critical factor to consider when evaluating any potential squeeze play is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of outstanding shares and reduces the ownership percentage of existing shareholders. This can significantly offset or even negate the upward pressure from a short squeeze, as more shares mean less value per share. For CCTG Technology International Holdings Limited, our check found no recent dilutive SEC filings like S-1, S-3, or 424B in the last 90 days. This absence of recent dilution is a positive signal for a squeeze thesis, as it means new shares haven't been recently introduced to dilute the float. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. If you're monitoring CCTG for potential squeeze dynamics, there are a few key metrics to keep an eye on. Continue to watch the cost to borrow fee for CCTG Technology International Holdings Limited. Any sustained increase from its current 635.7% would be significant. Also, pay close attention to the number of shares available to borrow. If that already low 10,000 figure shrinks even further, it adds more pressure. Finally, volume will be crucial. Today's relative volume for CCTG is very low at 0x its average. A true short squeeze often involves a massive surge in trading volume as short sellers scramble to cover and new buyers pile in. Price action will also be telling. Can CCTG build on its 30-day gains and reverse its recent 5-day dip with increased volume? CCTG Technology International Holdings Limited, or CCTG, presents an interesting case study in the world of hard-to-borrow stocks, with its exceptionally high cost to borrow and very limited share availability. Understanding these dynamics is key to navigating speculative opportunities in the market. Remember, high fees don't guarantee a squeeze, but they certainly signal a strained short market. We hope this deep dive into CCTG has illuminated the mechanics of short squeezes and why these factors matter. If you found this explanation helpful, please hit that like button, subscribe for more in-depth market analysis, and let us know in the comments what stocks you'd like us to cover next.